right. See something. Okay. All right. Let's see what's going on. Okay, guys, sorry. I didn't realize I was on mute. Welcome to the New York session stream. Looks like we're in this bit of a range. It's waiting for news. There's a lot of news today, so kind of have to, you know, maneuver around the news. This. Looks like the S&P 500 PMI is out. Okay. Oh. Interesting. I guess we're still above 50, you know. Show score above 50 usually means growth. So I think it's at 52 something. So I guess that was good news. Market is rallying. Also, we have this. This reminds me that hey, we might be in a reaccumulation. You know, right here. These three right here. And then we broke out right here. And then we reclaimed. That was beautiful, yeah. It all happened overnight. Then we reclaimed structure. Okay. Kind of did. But got a little wonky here. This was a good. Look at this, Check this out. This was great, actually. This is amazing. Look at that structure movement. And then something like this. Oh, kind of bonkers. But seems like a bigger structure here, even if it was here. But I don't know. It looks weird to me, so I'm gonna stay out of it. Okay, where are we on the one? Yeah, see, it's arranging right now, so SFP this, so that means this is the target. It's gonna take that guy out. I believe if you're trading top set, there is some sort of Okay, so I believe if you're trading top step, there is some sort of issue. They're down, so just be aware. Okay. All right, so we took that high. SFP this high was taken. Perfect. Let me see something. Let's see. Where's OBS? Yeah, what is this? Um. Okay. Usually, you know, a lot of people will take this model right now. Swept London lows or overnight lows. Actually, yeah, well, not even lows, but swept the low here. You got the sweep. We're gonna show this one for a second sweep. I mean, trying to see what's over there. Came down for. Let's see what it came down for. I don't. Yeah, I don't like this bounce. I don't know where it's bouncing off of, but I mean, what else is here? Are we missing something? I mean, there's this. There's this gap here. You know, but let's see what happens. Honestly, price action looks pretty shit. I might not even take a trade today. So, yeah, that's that. There's also this 5-minute unmitigated block right here. I like this for maybe a bounce. Huh. I don't know. This would be under VWAP. We'll see. Yeah, it's kind of just following structure, you know. Even though it got a little ugly back there, you know. Yeah. I'm kind of like SFP of this level. You see that? Kind of SFP this level, wicked it down. On our way up. Usually it goes to fill these gaps. So you have I guess you can call it the fair value gap. I'll put alert there. You know, maybe we can see something like this. Okay, here comes the doodle. Here comes the doodle, man. I'm telling you. Here comes the doodle, boys. You know, something like this. When you see something like that, we get on the retrace, and then we go down. You know, that's one way of looking at it. Or we can just keep going up. Let's see if the supply holds. Let's see. Oh, session view up. I need to put the session view up. Why is this here? This should be the first one. And I have these. I like this here. I'm just kind of see. See, this in the middle is fine. What do I use more? I use these more. A lot more. And this. Yeah. This should be right here. Definitely gets used a lot more. Okay. Okay, we'll play some music or something, man. You know, maybe that's what it needs. You know, you need some sort of music. That's some sort of, you know. It says work music for serious grind.
We'll be able to have the very granular.
So what our boy is saying.
While this data is not available.
This is live. Let's check on OBS something. Okay.
It isn't the gold standard, or that you're relying on your own surveys of the beige book. Do you worry at some point you're going to have to start making policy by anecdote? You know, this is a temporary state of affairs, and you know we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that you know, what do you do and if you're driving in the fog, you slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm saying it's certainly a possibility that you would say
He's resigning.
we really can't see, so let's slow down.
As a follow-up in this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower cost products, but that at the top people are spending at the higher income and wealth, and so much
Age deviation
anecdotal
here.
data on that, and so we think there's something there. So
Edward.
Then you got
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further.
I do want
reduction
this
in
zone to
rates,
get hit,
not a
but I
foregone
don't know if
conclusion.
it's
So
gonna get
December, you
hit.
said far from it. So if a cut
I
might
want
not
this
be
zone
on
to
the
get
table for December
For
because of
taking
lack
the
of
shorts,
data,
but
what is the other concerns then
it's
stem from?
it's a long shot.
So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
well, the perspectives of people on the committee that we've now moved 150 basis points, and that we're down into you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there's a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
Yeah, so on that division then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have in fact cut 2 more times, and we're 150 basis points closer to neutral, wherever that may be, than we were a year ago.
Okay.
And so there's a
Let's see
growing
if we'll
chorus
play
now
here.
of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes, and I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think
The
the
exclamation marks on
there are
so you
two
guys
things
can
affecting
see where
the job market. And
executing.
one of them
See,
is just
a lot of people probably got faked out on this.
dramatic reduction in the supply
But
of new workers.
If you look at
So
volume,
that's two things. That's
as soon as you know
declining
this is
labor
coming
force
down,
participation, which is a cyclical thing, and then there's declining immigration, which is just
volume
big
just
policy
dies.
change that actually began in the last administration
Okay.
and has been accelerated
And
now.
then you have buying
So,
volume,
A
so
big part of the whole story is
that's
the supply
a
side
no-go.
story. Okay. In addition, labor
Let's
demand
turn this
has
bad boy
declined,
down.
and you know, so the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply.
Okay.
So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the
We're above
tool
both
do, which
both
supports
view
demand?
ops, right? Gapped
And,
up
so
over here. I
and
got
I would
sorry.
just say when
pushed up
you're in a situation
fast, and then you
where
have this.
job creation, if you adjust for
Yeah.
likely overcounting.
So
way
I
that
mean,
BLS
essentially,
does
we're
its
ranging
work,
right now.
it's pretty
I
close
guess
to zero.
due to like
So
Powell
maximum
speaking
employment
and just
doesn't,
traders
on
are
a
looking for
sustainable basis
direction.
if you're creating zero jobs.
Yeah. So
if it's in equilibrium, if it's
I mean,
in balance, it's a pretty, as I said before, a pretty
short term, I
curious
think
balance. So
I'm looking at
you know,
the
I thought
downside,
many of
but
my colleagues thought, in fact,
you know,
you've
I have to
seen
see.
the last two meetings, that it was appropriate for us to
I need a
react by
notable zone to
supporting
get hit.
demand.
I want to
with
see
our-
some bigger
with our
structure. I want to see
rates.
some
And we've done
VWAP
that. We've reduced so
loss.
that rates are looser.
Then I
They're
can
say
short.
that they're
Other than that,
accommodated
I mean,
right now, but they're
I'm not in
meaningfully
this
less
thing
tight than they were.
doing anything.
And that should help.
Sometimes you
so
just
that
have
at
to
least
watch
the labor
price.
market doesn't
you
get
know.
worse. So it's a complicated
I have to
situation.
trade every day.
And some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in
Maybe that's
inflation
range.
because it takes a while for tariffs to work their way through the
maybe that's just a big
production
range.
chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in,
I like the
they
shorts.
stop generating inflation. You
telling
get
you.
a one-time price increase. As long as you're not, at least this is the
I've been
theory.
liking
This
the
is how
shorts,
we
but
believe and hope that it will work out.
Some
Once the
slight
last
aside.
tariff is put on something,
I like it, but
at that
something
point,
is.
it becomes
I mean,
a higher price level.
I'm not
because
seeing a
it
convincing
stops
break
going
yet.
up,
You know.
if you will. Prices stop going up; they'll just be at
I
that
don't
level, and
see
then measured
look at that.
inflation will come back down.
This
to
just could be
non-tariff
another
inflation. As I
reaccumulation
mentioned,
model.
Non-tariff
Can just
inflation
accumulate and then
is
go
not
up.
so far from 2% now.
So-
Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even
Yeah.
and it's nice
Yeah,
that,
have to wait
that,
for
that
price to kinda do
prices
something.
are not going up as
Good
fast as they
direction.
were, but they're still much higher than they were, and it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close
Okay,
to
I'm gonna
being
take a short
overvalued
here.
at this point?
You know, we don't look at any one asset price
They're
and say,
breaking
hey,
this
that's
level,
wrong.
I think
It's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margins are higher than earlier in the year as inflation for goods has picked up. In
Honestly,
contrast,
not getting into
disinflation
until
appears to be
Paul's not
continuing
talking.
for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent,
Yeah, the shorts are
and that
looking
is a
good.
risk to be assessed and
No
managed.
break of structure.
Our obligation is to ensure that a one-time
Velocity
increase in the price
walk.
level does not become an ongoing inflation problem.
We're in this gap right
In the
here.
near term, risks to inflation are tilted
So
to the
nothing
upside,
to worry about.
and
This
risks to
gap.
employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a
Price
balanced
definitely
approach in
failed to
promoting
stay.
both sides of our dual mandate.
Okay.
With downside risks to
This
employment having increased in
means,
recent
you
months,
know,
the
prices
balance of
feeling
risks
to go
has
up
shifted
higher.
to stance.
No.
With
No.
today's decision, we remain
That
well
being
positioned
said,
to respond in a timely way.
We are
to
in the middle of
potential
the range.
economic developments.
So I usually like to,
We will continue to determine the appropriate
take trades
stance
from
of
like
monetary
this
policy
area or
based
this
on the
area.
incoming data,
But
the evolving
we are
outlook,
in this middle of this range.
and the balance of risks. We continue to face two-sided
Short
risks.
looks good.
In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with
Okay.
ample
But we
reserve
have break
conditions.
of structure.
Signs have clearly emerged
I
that
wanna
we have
see-
reached that standard.
tap back
In
into
money
this.
markets, repo rates have moved up relative to our
I want to see
administered rates,
something like
and we have seen more notable
if it could
pressures
take
on
this,
selected dates
sweep
along
this
with more
high,
use of our standing
come
repo
to
facility.
this, gets rejected,
In addition, the effective
you know,
federal funds
comes
rate
down again,
has begun to move up relative
and
to
then
the
work
rate of
its way
interest on
down.
reserve
I'd
balances.
like to see that,
These developments are what we expected to see
but
as the size of our
I don't know
balance
if we're
sheet
gonna get that.
declined and warrant today's decision to cease runoff.
See,
Over the
I
3.5
don't,
years
I'm
that
not
we've
gonna
been
be the
shrinking
guy.
Our balance sheet, our securities holdings have
Yeah,
declined
I'm
by
not gonna be the
$2.2
guy who's
trillion.
gonna,
As a share of
you know.
nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time.
so this is
while
the
reserve
target
balances
right here.
continue to move gradually lower as other non-reserve
put our,
liabilities
these
such as
real big
currency
targets
keep
right here.
growing.
Target
We will
right
continue
here.
to allow agency securities to run off our balance sheet, and we'll reinvest the proceeds
the
from
target.
those securities in treasury bills, furthering progress toward a portfolio
know.
consisting primarily of treasury securities. This reinvestment strategy will
This
also
drop
help
was
move
what?
the weighted average maturity of our
150
portfolio
points.
closer to that of the outstanding stock of treasury securities, thus furthering the normalization of the composition of our
contract.
balance sheet.
But it made you a lot of money on that one.
The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting
Let's see.
maximum employment,
Yes,
bringing our
around
inflation
there.
sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So
You don't want to
I would
short
say
into the
that needs
VWAP.
to be taken on
Kind of
board. We had,
prefer
I would just say this, 19
retracement.
participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking
That's
about
beautiful.
it
Look at the way it's kind of
the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and it suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today. It's sort of the same logic. But as I mentioned, going forward is a different thing.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment
That's all I
we're
want,
seeing in
but-
AI and some of the generation of household wealth through
We'll see.
rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, you know, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, you know, that we haven't made a decision about December. You know, I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the US Treasury issuing more short-term debt?
You know, that could be one of the factors, but the reality is we've seen, you know, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, you know, the place we're trying to reach. What we said for a long time now is that when we feel like we're a little bit or a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, you know, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, you know, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, you know, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, you know, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, you know, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, you know, that would certainly play into our decisions going forward. So, we do have, you know, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get, you know, job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market. And, you know, the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So, you know, we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's, the meeting's, I guess, 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving. But we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. and that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case, and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.